To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So friends, let's now understand how do we account for investment in associates in consolidated financial statements. So we'll be talking about Accounting Standard 23, which deals with investments in associates in consolidated financial statement. Okay, don't read this as cash flow statement, it is consolidated financial statement. Now, which standard deals with consolidated financial statement? Consolidated financial statements we learn in Accounting Standard 21. So, the chapter of consolidated financial statements is guided by AS 21, right? Now, regularly or normally when we talk about investments, we have one standard which is Accounting Standard 13 that deals with investment. How should we account for it? What is included in cost, right? How do we account short-term investments, long-term investments? All of those things you learn in Accounting Standard 13. This Accounting Standard 13, whatever it tells us or whatever guidance is given, that is for what we call standalone, or we can also call it separate financial statements. Meaning to say, in the standalone financial statements, how should we account for investments? That is given by Accounting Standard 13. So, just to give you a perspective, let us say we have Reliance Industries Limited. Reliance Industries Limited has a subsidiary by the name, let us say, Reliance Jio. Okay, Reliance Industries subsidiary Reliance Jio. Now, whenever you have a holding subsidiary relationship, or sometimes we also call it parent subsidiary relationship, what we do is for the entire group means the holding and the subsidiary company put together, we say it is a group. Holding subsidiary put together, for the entire group, what we prepare? We prepare consolidated financial statements. Now, before we prepare consolidated financial statements, Reliance Industries Limited will present or prepare its separate or standalone financial statements. Means, as an entity, the standalone financial statements are prepared by Reliance Industries. Reliance Jio will also prepare its separate or standalone financial statements, and as a group, Reliance Industries Limited will cover or will prepare consolidated financial statements. Now, for now, ignore for a moment that these are listed entities. Consolidation part or preparation of consolidated financial statements is governed by Accounting Standard 21. Okay, now when you come to CA final, you will understand the corresponding Ind AS 110, where we talk about consolidated financial statements. So, for Reliance Industries, Ind AS 110 will guide it. Corresponding standard is Accounting Standard 21. And separate financial statements, using your individual accounting standards and Schedule 3, you will prepare the separate financial statements. Now, we are getting into one more topic called AS 23, which is talking about investments in associates in consolidated financial statements. So, when an entity prepares a consolidated financial statements here, what we have understood, when Reliance Industries prepares consolidated financial statements, if it has an associate, sir, who is this associate? We'll come to it. Okay, if it has an associate, then how should that investment be accounted for in consolidated financial statements? That guidance is given by Accounting Standard 23. So, if there is an associate, for your understanding, let us say Reliance Industries Limited holds 25% shares in OneFin or Indigo Learn, and that will be one of the finest day for us, right? So, if Reliance Industries holds 25% shares in OneFin or Indigo Learn, is Indigo Learn a subsidiary? It is not a subsidiary. Indigo Learn is not a subsidiary. And if it holds 25% shares, can Reliance Industries influence our decisions? Yes, it can, because it has a good amount of stake. So, there is a presumption that if there is a 20% threshold criteria, if that is met, then we assume that the investor influences the investee. Reliance Industries is the investor, this is the investee, right. So, if there is a significant influence, Reliance Industry is significantly influencing OneFin. Now, in that case, what do we do, or what do we call? We call this OneFin or Indigo Learn as an associate. We call this as an associate. Now, what AS23 tells us is, while preparing consolidated financial statement, how should you account for investment in this particular associate? That is given by AS23. Sir, in standalone financial statement? In standalone financial statement, the Reliance Industries will apply accounting standard 13. Of course, it's a listed entity, so it will have to apply Ind AS 109. Okay, no need to worry about the number. It has to apply Ind AS 109, but for our understanding, we'll assume this is not a listed entity. So, it has to apply accounting standard 13 for accounting for investments in OneFin. So, two things. In separate financial statements, you will apply AS 13. In consolidated financial statements, you will apply AS 23. On what? On your investments in associate, right. So, in this chapter we will understand how do we do this accounting for, who is an associate, when this standard comes into picture, all of those things we will understand in this standard. Now, we have understood where we will apply accounting standard 23, that is to deal with investments in associates in consolidated financial statements. See, if it's a standalone financial statements, you will refer to AS 13, right. So, wherever consolidated financial statements are being prepared, and when do we present consolidated financial statements? When we have a group, that is parent and all its subsidiaries. So, the holding and the subsidiary companies put together, we say it is a group, and we prepare consolidated financial statements. Now, it may be possible that if we have, let us say again Reliance, you have something like Reliance Jio, which is a subsidiary, and there could be other investments like we said OneFin, which is an associate. Now, the question is, how will this investment be treated in consolidated financial statements, right. Now, consolidated financial statements are basically financial statements of a group which are presented as those of a single enterprise. So, we think the entire enterprise is a single enterprise, and accordingly we prepare consolidated financial statements, right. Now, an important question that arises is, who is an associate, or what is an associate? An enterprise in which the investor means the company which has made the investment, in our example Reliance Industries, has significant influence. Now, when we say significant influence, this is not control. When one entity or one investor controls the investee, we say there is a holding subsidiary relationship. So, where there is control, it is holding subsidiary. When there is significant influence, now what is the difference between control and significant influence? When I am saying I control, I can decide. When I am saying I influence, I can only influence you, but decision will be taken by you, right. So, when I am controlling you, I will decide for you. You have to listen to what I say. That is what is control. But when I am saying significant influence, I will influence your decision. I will give inputs. I will say this is acceptable, this is good, that is bad. You listen to me, but I can only influence. Ultimately, you will take the decision, right. So, associate is an enterprise in which the investor has significant influence, and that enterprise should not be a subsidiary and not a joint venture. So, it cannot be a subsidiary. If it is a subsidiary, what we will apply? Accounting standard 21. If it is a joint venture, we will apply accounting standard 27, right. So, these two standards will come into picture. So, it must be significant influence and not a subsidiary and not a joint venture. That entity we call to be an associate. Normally, there is a presumption that if you have 20% or more stake, so if one company has or one company owns 20% or more voting power in the other entity and up to 50%, then we say there is a significant influence. And generally, if it is a 50% stake, it would fall in the category of joint venture, which we will understand subsequently. So, anything from 20% to 50% category, there is a presumption that there is a significant influence, unless it is proved otherwise, right. Now, what is a significant influence? Significant influence is power to participate in the financial and operating policy decision of the investee, but not control over these policies. So, I am saying when I have an influence, I will participate, I will give you inputs, I will influence you, but I cannot control. Sir, what if we control? Sir, what if there is a control? If there is control, then it becomes a holding subsidiary relationship, right? So, that is very important for you to understand that we can only participate, but we cannot decide. We can only participate, but we cannot decide. Now, how do we influence the economic decision? How can we influence? How can Reliance Industry influence OneFin? See, if they are holding 25%, they will have to listen to them, right? Otherwise, if they sell off that 25% to somebody else, or if they dump it in the market, our valuation will go for a toss. So, that is where they will have some kind of power over us, but they cannot control us, right? So, now significant influence can be obtained by having some voting power, as we said, 20% or more. By having representation on the board of directors or governing body of the investing. Now, when we talk about control, when there is a holding subsidiary relationship, there it is not just a representation, it is a power to appoint and remove the directors on the board, the majority of directors on the board, then there is control. But if you just have representation, for example, there are 10 directors, we have 2 directors on the board. So, the company which has 2 directors on the board, we can say there is a significant influence. So, if for example, Reliance Industries has 2 out of 10 directors on OneFin, then there is a significant influence, right. Then participation in the policy making process. Participation means they will participate in the day-to-day policy making process. And see, there is no hard and fast rule, right. There can be a combination of this. You have to look at the substance of the transaction. Looking at the substance of the transaction, is there a significant influence? That is the question you have to ask. And if there is a significant influence, then the other entity becomes an associate and AS23 becomes applicable, right. Now, when we talk about control, where there is a parent subsidiary relationship or holding subsidiary relationship, then in which cases we say that one entity is holding and another entity is subsidiary company. Of course, you have learned this in consolidated financial statements, we will be revising that again. Ownership directly or indirectly through subsidiaries of more than 1/2 of the voting power of the enterprise. So, if the holding has more than 1/2 means greater than 50%, what voting power in the other entity, then the first entity controls the second entity. To give you an example, Reliance holding subsidiary Reliance Jio. So, maybe Reliance holds, for example, here in this case Reliance and Reliance Jio holds, let us say 75% of voting power. Then we say Reliance Industries controls Reliance Jio. Reliance Industries controls Reliance Jio. Now, sometimes what happens is you have Reliance Industries Limited, then you have Reliance Retail. So, let us say Reliance Industries owns 80% of Reliance Retail. Then you have Reliance Jio, which owns 75% in Reliance Jio. So, Reliance Industries controls Reliance Retail controls Reliance Jio, indirectly Reliance Industries also controls Reliance Jio. That is one more relationship. Or sometimes what happens is you have RIL, you have Reliance Retail, and then you have, let us say, Reliance Jio. Reliance Industries holds 80%, so this becomes a subsidiary. Reliance Industries hold 30% here directly, and Reliance Retail holds, for example, let us say 40% here. Okay. So, here 30% directly it can control, 40% it can control indirectly, put together it is more than 50%, and hence it is a parent subsidiary relationship. Sometimes what institute does is, they take 80% or 40%, that is 32% effective control, but generally if it is held through a subsidiary, effective control is not needed. If you are holding 40% through a subsidiary, because see, Reliance Retail will do what Reliance Industries says. So, they directly can influence 40% of the decision and 30% directly. So, that way it is a subsidiary, right. Now, in the first case we saw by having more than 50% voting power, one entity can control another entity. Now, the second scenario is by controlling the composition of board of director, meaning to say if you have, let us say, if you have Reliance Industries Limited, they control the board of directors, the composition of board of directors of one fin, for example, then in that case this becomes a subsidiary. Let us say out of 10 directors, they control 6 directors. Majority of decisions will be as per Reliance Industries, and then there is a control established, right? Now, the next question is, how do we control the composition of board of director? By being able to appoint the directors on the board, right? So, an enterprise is deemed to have the power to appoint a director if any of the following conditions are satisfied. Now, when we say that we have to control the composition of BOD, basically you must be able to appoint, okay, some specified number of directors, which gives you control over the composition of board of directors. Now, how can we appoint, or when do we say that one enterprise can appoint a director on the board? So, in any of these 3 cases, if any of these 3 conditions are satisfied, we say that one entity can appoint a director on the board of the other entity, right? So, the first scenario is when a person cannot be appointed as director or member without the exercise in his favor by that enterprise of such a power. So, what are we saying? An enterprise is deemed to have the power. When do we have that power? We have that power when a person cannot be appointed as a director or a member of the board unless we exercise that power in his favor. Basically, unless we say that this Mr. X has to be a director, Mr. X cannot be a director. Then in such case we say we have the power to appoint a director or a member on the board. Second, a person's appointment as director follows necessarily from his appointment to a position held by him in that particular enterprise. Now, what does that mean? Say for example, I am Reliance Industries managing director. Because I am managing director in Reliance Industries, I am also appointed by default as a director in Reliance Jio. So, that is the relationship. So, the moment someone becomes a managing director of Reliance Industries, automatically that person becomes a director in Jio. That is where this person, MD of RIL, is also a director in Jio. So, the appointment as director in Jio follows from his appointment to a position held by him in that enterprise. So, if he is a managing director, or if he is an executive director, or if he is a CFO, some designation, by default you are a director in the other entity. In that case also, the first entity has power to appoint directors in the second entity. See, these kind of relationship, and also in AS 18 what you have to understand is there are 2 entities. One is first entity and the second one is second entity, right? Now, what are we saying? Because you are managing director in first entity, that is Reliance Industries Limited, you automatically become a director in the second entity, which is Jio. So, because you are MD in Reliance Industries, you are a director in Jio. That is the second condition. By default, you don't have to do anything. That in that case also, the first entity has a power to appoint the director in the second entity. The third one, the director or member is nominated by that enterprise or a subsidiary thereof. So, the enterprise, Reliance Industries, or a subsidiary can nominate. Nominate means if I say this person has to be appointed, I can nominate. There is no voting required, nothing is required. I can directly nominate that person as a director on that second entity, right? In that case, we say that this particular enterprise has power to appoint director or a member in the other entity. And if that happens, and by way of appointing these directors, if you have control, then there is a holding subsidiary relationship. If there is no control, let us say we can appoint only 2 out of 10 directors, then the relationship becomes one of a investor and associate, right? So, that is one thing what we have to understand. Now, there are a few other smaller definitions that we need to understand. One is equity method. This equity method we will do as we do some problems, as we learn the concept. Then equity. Equity basically means the amount that is left over, or the interest that is left over after paying off all the liabilities. In an enterprise, you have all the assets, you take all those assets, settle all the outside liabilities, whatever is left over is called equity. So, equity is residual interest in the asset of an enterprise after deducting all its liability. So, take the assets, remove all the liabilities, whatever is left over is equity. Now, how do we account for investments in associate in consolidated financial statements? The standard says you have to follow equity method. Now, what is this equity method? Very simple. You have already learned this method when you learned partnership accounting. So, let me give you a partnership accounting example, and then we will extend this example to investment in associates. Now, when there is a partnership, let us say there is a partner, standard example, let us say there is a partner A, B and C, 3 partners. They have started a partnership firm. Now, in the book of partnership, you have capital account. So, let us say you have capital account of A. In the capital account, what do? Whatever capital is contributed, you say by cash or bank. Let us say 10,000. Profit earned during the year by P&L appropriation. Let us say 2,000. Drawings made during the year. Of course, you can have a separate drawings account, but you can also debit it to the capital account. So, you will say to cash 1,000. Now, 1 lakh plus 2,000, 10,000 plus 2,000, 12,000 minus 1,000, 11,000. What do you say? You say to balance carried down 11,000, right? So, that is how you prepare A's capital account in the partnership book. Simultaneously, what A will do is, in his book, in A's book, he will say investment in partnership, right? Now, how will you account for this? You would say to bank 10,000, investment made, whatever amount you have contributed as capital, you will say to bank, amount invested. Then whatever is the share of profit, you will account for it as your share. So, you will say to share of profit 2,000. Whatever amount you have withdrawn, you will say by cash or bank, whatever is the number. I think we used cash there, 1,000. By balance carried down 11,000. Now, the way you have investment in partnership account here in A's book, this is prepared using the equity method. Basically, what it says is, if the partnership gets dissolved today, forget revaluation and all of that, if the partnership gets dissolved today, as per the partnership balance sheet, I have to receive 11,000. What is this? This is my residual interest in the partnership assets. This is my share of residual interest in the partnership asset. This is what is called equity. This is my share in equity of the partnership firm, right? This is what is called the equity method. Now, how will a company account for these transactions as far as investment in associate is concerned? Whenever there are investments, this represents investment. So, whatever investments are made, they are recorded at cost. Then you will account for share of profit of what? Share of profit of associate is also accounted for, not in standalone financial statements, only in the consolidated financial statements. So, you will account for share of profits. Then, if there are any dividends paid, because we have companies, we will not have drawings, we will have dividends, that dividend will be deducted, and the closing balance represent investors' share in the associates equity, right? So, that is what is represented by the closing balance. So, if you look at in investment in associates, you will have the bank, you will have the share of profit taken to consolidated P&L, by bank if dividends are received, if there is a loss, and then the closing balance. Now, in a nutshell, investment is recorded at cost, and if there is a calculated goodwill component or a capital reserve component, we see, right, investment made versus net assets, that component is goodwill or capital reserve, it is not recorded separately. In consolidated financial statements, you record that goodwill or capital reserve separately. Here, you will not record the goodwill or capital reserve separately. Meaning to say, whatever is the investment, this investment includes goodwill, and you will not measure or present goodwill separately. Then, distributions received from an investee reduce the carrying amount of the investment. Whatever dividends are received, you will reduce it from the investment balance, or you will credit it to the investment account. Then, any subsequent change in the share in net asset is adjusted in the cost of investment. So, If at all the share in net asset changes for whatever reasons, it will be adjusted in investment and goodwill and capital reserve, but these are not presented separately. And lastly, consolidated P&L will show investor share in the results of operations of the investee. So if there is a profit, you will take it to consolidated P&L. If there is a loss, that also goes to consolidated P&L. This is how investment in associate is accounted for. If I have to tell you, this is one of the simplest thing that you will learn in consolidation. But there can be a challenge if consolidation with subsidiary, associate, joint venture, if all of them are given together, then you have to be slightly extra careful. Now, so far we have understood that if we have an entity or what we call as enterprise, there is one enterprise, and if it holds 20% or more investment or voting power in another entity, let us say this is another entity B, this is enterprise A, then entity B is considered to be an associate of A. So entity B becomes an associate of A. So the default rule is, do we have 20% or more of voting power? It is presumed, if we have 20% or more, it is always presumed that this particular entity is an associate of the first entity. If it is less than 20%, then it is presumed that it is not an associate. However, we have to look at substance over form. In some cases, maybe even after having 20% or more of voting power, the other entity is unable to exercise significant influence, maybe because of some contractual arrangements, right, because of which they are not able to exercise significant influence. In that case, you will not consider the relationship to be an associate, right. So what you have to do? First threshold, 20% or more. Even if it is more than 20%, then also you need to check, in substance, is there a significant influence? And sometimes the investment may be less than 20%. So there could be a case where there is less than 20. There could be a case where there is less than 20% investment. But even then, maybe entity A, the first enterprise, is able to exercise significant influence and participate in the policy making decisions of the other entity. So threshold is 20% or more, but even then you have to look at substance over form. Sometimes what happens is, there may be contractual arrangement between these two entities, because of which A is exercising influence over B. Sometimes there are a lot of material transactions. Maybe enterprise A is supplying some technical know-how to entity B. You have supply of some technical know-how. Now in that case, even though there is no voting power or voting power is less than 20%, because of this technical know-how, A may be able to exercise significant influence over B. So what you have to see is, can entity A influence the decision making of entity B? That is when we say, there is a significant influence. Now just to give you some hints to remember or to correlate it with your day-to-day life, if you look at your relationship, let us say you have parents and then you have your uncles and aunts, okay, and these parents have kids or children, whatever you say. Now parents control kids because whatever they say you have to follow. Uncles, they may have significant influence over the kids. They can influence, but who will decide? They will decide and they will decide, right? That is one more thing what I wanted to just help you understand. Now, sometimes what happens is, one entity may be a subsidiary of another entity. For example, you have A Limited. A Limited controls or owns 80% of voting power of B Limited. Then what happens? A Limited becomes subsidiary of B Limited. Then you have, let us say, one more entity, C Limited. C Limited owns 20% of B Limited. Now, if you look at this, A Limited is what? A Limited is holding. B Limited is what? This is a subsidiary of A. Also, because it has 20% voting power, and if C can exercise significant influence, B also becomes associate of C. So when A Limited prepares its financial statement, the consolidated financial statements, they will include B Limited as a subsidiary. When C Limited prepares its consolidated financial statement, because it may also have some subsidiaries, in that case they will consider B Limited as associate of C Limited. Now just because B Limited is subsidiary of one company does not mean then it cannot be an associate of another company, and there can be situations where let us say you have one company called C Limited. A owns 35%, B also owns, let us say, 40%. C Limited is an associate of A, C Limited is also an associate of B. So that kind of relationship also exists. Then sometimes what happens, let us say you have A Limited. A Limited holds 80% of B Limited. A Limited holds 80% of B Limited. There is one more company called C Limited. A Limited holds 10% in C Limited. B Limited holds 15% in C Limited. 10% A Limited holds directly, B Limited holds 15% in C Limited. Now, who is B? B is subsidiary of A. A controls B, and because A controls B, because A can decide what B can do, this 15% also A can decide, because B has to do whatever A says. So for this 15% also, whatever A says, B has to do. So A indirectly owns 15% in C Limited, directly owns 10% in C Limited. Now, if you see this 10% plus 15%, what is the power? 25% is owned by A Limited in C Limited, directly plus indirectly. Is it 20% or more? Yes. So this relationship between A and C is also of an associate. But one thing that you have to keep in mind is, whenever you do the consolidation or whenever you calculate share of profit, what A Limited will get is 10% directly, and because this 15% is through B, of which we have only 80%. So think of it, if C earns 100, if C earns 100, A will get 10 directly. Why? Because we have 10%. So out of this 100, A gets 10 directly. How much will B get? B will get 15, not 150, sorry, B will get 15. B will get 15. Sir, why will B get 15? Because B has 15% stake, right? Now, will entire 15 of profit be enjoyed by A? No, because 80% is what A owns, 20% is held by others. So, out of this 15, 80%, that is 12, will be enjoyed by A, and 20% remaining, that is 3, this will be enjoyed by minority interest. So, A Limited directly you get 10%, and indirectly through B, how much we will get? We will get 80% of 15%, that is 15 into 8 is 12. So 12 plus 120, it is 12%. So total consolidation will be 10% plus 12%, 22% only. So we have to understand two things. To check whether it is an associate or not, you will see how much is controlled. How much is controlled here? I am repeating once again. 10% is controlled directly, 15% through B, because 15% through B. Sir, why not 12% through B? Because for this entire 15%, A can decide, because A controls B. So for stake purpose, for checking the voting power purpose, 10% plus 15%. For share of profit, 10% directly and 80% of 15% through B. So the total consolidation will be 22%. So now we have understood who is an associate, we have understood how the accounting happens broadly. So what we'll do is we'll take one illustration, and step by step we will see how investment in associates is presented in the consolidated financial statements, right? So let's have a look at this illustration. A Limited acquires 45% of B Limited shares on April 1st of year 1. The price paid was rupees 15 lakhs. Following are the extracts of the balance sheet of B Limited as on 1st of April of year 1. So when did we acquire? 1st of April of year 1. When is the balance sheet given? 1st of April of year 1. Paid up equity share capital 10 lakhs, securities premium 1 lakh, reserves in surplus 5 lakhs. Now, what does this represent? The share capital and reserves in surplus represents net assets. Net assets of whom? Net assets of B Limited. Okay. So, when we acquire 45%, we also get a right to 45% of the net asset. Now, why is this relevant? This is relevant because we have to see how much is the net asset. Of the net asset, how much is our share, or how much do we control, that is 45%, and how much we have paid. The difference will be goodwill or capital reserve, which has to be disclosed. Please understand, we will not present goodwill as a separate amount. We will only present investment. What we are bothered with is 15 lakhs of investment. That is what we will present. But we will disclose that it has either a component of goodwill or capital reserve in our financial statements. Then B Limited has reported net profits of 3 lakhs and paid dividend of 1 lakh for the year ended 31st March of year 2. Now 3 lakhs is the total profit. Out of that, how much will A Limited enjoy? 45%. Again, dividend is 1 lakh. How much will A Limited enjoy? 45%. Calculate the amount at which the investment in B Limited should be shown in the consolidated balance sheet of A Limited as on 31st March of year 2. So what we need to do? We need to calculate the goodwill or the capital reserve amount as on the date of acquisition, and then we have to see what is the investment balance as at the end of the year. So first calculation will be on 1st of April and second calculation will be on 31st of March. So now let's see how do we approach this problem, right? So first we have to see what is the net asset. So what we will do? Calculation of goodwill or capital reserve on which date? 1st of April of year 1, right? So here we have to see what is the paid up capital, securities premium and reserves. Okay, so reserves and surplus, paid up capital 10 lakhs, security premium 1 lakh, and this is 5 lakhs. So you have 10 lakhs, amount in lakhs, 10 lakhs, 1 lakh and 5 lakh, total is 16 lakhs, right? That is the total net asset of B on 1st of April. Now, what is our share? Share of A is 45%. So, which is 45% into 16 lakhs, that is equal to 16 5 8 is 0, you get 8 carried, 16 4 is 64 plus 8, 72. So, 7.2 lakhs, that is 7 lakhs 20,000. What is the amount paid? Amount paid is 15 lakhs. Now, always remember, whenever amount paid is more than the net asset, it represents goodwill. If you are paying more, it is goodwill. If you are paying less, it is capital reserve. So, we have paid more, hence there is goodwill, that is 15 lakhs minus 7.2 lakhs, that is equal to 15 minus 7 is 8, so 7.8 lakhs. That is the goodwill amount. We will not say goodwill separately in the consolidated financial statements. This will not be shown separately. It will be included as a part of your investment of 15 lakhs, right? So that is the first part, which is, what we have just calculated, investment 15 lakhs, total investment is 15 lakhs, equity shares 10 lakhs, securities premium 1 lakh, reserves and surplus 5 lakhs, total is 16, net assets, 45% is 7 lakh 20,000, goodwill is A minus B, which is 7 lakh 80,000. Now we have calculated what is the goodwill. As I told you, we will not recognize goodwill separately in the balance sheet. It will be a part of the investment. The second one, what the question has asked us is, what is the investment as on 31st of March of year 2, right? Investment in B in the consolidated financial statement. Now the way you should start is, first, what is the cost of investment? Cost of investment, the question has given us, which is 15 lakhs. So you just take 15 lakhs. Here you can give the breakup. Net assets 7 lakh, net assets 7 lakh 20,000 that we have calculated, and goodwill 7 lakh 80,000. This we have already calculated, so this can be presented. To this we will add share of net profit. So like I told you in the previous module, the way we calculate share of profit in partnership, what is our share? Now our share is how much? 45% of how much? 3 lakhs. The profit earned is 3 lakhs, right? The profit earned during the year is 3 lakhs. Of this we are entitled, when we say we, A is entitled to 45%. So that is our share. 3 lakhs into 45% if you have to do, 45 3s are 135. So that is 1 lakh 35,000. So that is my share of profit. This will be recognized in consolidated P&L. Consolidated P&L. Then they have paid dividend. So we will reduce that, less dividends. Now how much dividend have they paid? They have paid 1 lakh. Will we get 1 lakh? No, we will get only 45% of 1 lakh. So 45% of 1 lakh, if you do, you get 45,000. So 15 lakhs plus 1 lakh 35,000 minus 45,000, if you do, 135 minus 45 is 90. So 15 lakhs 90,000. So this is the value at which you will show the investment in associate in the consolidated P&L. Now one thing that you have to understand is this dividend income, whatever you have calculated, or dividend amount what you have calculated, this will be shown as income in standalone financial statement. But here in the consolidated financial statement, this will not be shown as an income. Don't consider that as an income. Sir, why? Because we have taken this part. We have taken entire share of net profit as income. So in the consolidated P&L, what will happen is, or in the reserves and surplus of consolidated financial statement, what will happen is, you will show profit from B as 1,35,000. So this is how the balance sheet will be presented. Consolidated balance sheet of A, you will show the entire profit of 1,35,000, right? Now if you look at it from the point of view of consolidated financial statement, how will it look? That also I'll show it to you. In the consolidated financial statement or consolidated balance sheet, on the reserve side, what you will say? Share of profit. How much? You will say 1,35,000. This will increase your reserves, right? Then you have received dividend. So when you receive dividend, what will happen? It will increase your bank by 45,000 and it will reduce your investment by 45,000, right? Then the share of profit 135, this will increase your investment by 1,35,000. So 135 increase in investment, 45,000 reduction in investment. Your investment from 15 lakhs will come down to 15 lakhs 90,000 and 45,000 will be increased in your bank balance in the consolidated P&L. That is how you will account for, or that is how you will show in the consolidated financial statements. So whenever you have to show investment in associate, what you have to do is you have to first see what is the cost of investment. Let us say the cost of investment is, if it is 1 lakh, what is the share in net assets? Let us say the share in net assets is 60,000. So what is the goodwill component? Goodwill will be 40,000. So how will you present in the balance sheet? In the balance sheet you will say investment 1 lakh. In the bracket you can say share of net assets, that is 60,000, and goodwill 40,000, or otherwise you can just say including goodwill of 40,000, or alternate presentation is share of net assets 60,000, add goodwill 40,000, cost of investment 1 lakh. Right? So either way you present, it is absolutely fine. Now what if the share of net asset is greater? So for example, if it is cost is 1 lakh, share of net assets is, let us say, 1,20,000. Now here net assets are more and we have paid less, means there is a gain. So the difference 20,000 is nothing but your capital reserve. How will you present? In the balance sheet you can say share of net assets 1,20,000 less capital reserve 20,000, cost of investment 1 lakh. Right. So this is how you can present these items in the financial statements. Now let us look at few scenarios where there is a case where Initially, we have acquired, let us say, only 10% in year 1. In year 2, we acquired another 15% and hence we became 25%, and then the other party became the associate, or the investee became an associate. How do we handle this scenario? Or if there is a loss, to what extent should we bear the loss in our consolidated financial statement? These aspects we will understand taking few examples. Now friends, sometimes what happens is there are multiple acquisitions. For example, if you look at this timeline, let us say this is 1st of April and let us say there is another acquisition on 30th of September. A has acquired certain stake in B. On 1st of April they acquired 10%. On 30th of September they acquired 15%, right? Now on 1st of April there is no associate relationship, whereas on 30th of September 10 plus 15 makes it 25%, and hence on 30th of September the associate relationship is established. Now the question is, how do we calculate goodwill or how do we calculate capital reserve on these kind of transaction? Should we calculate based on 30th September only, or should we calculate also for 1st of April? So the way we have to approach is, once this associate relationship is established, you will calculate separately as on 1st of April, you will calculate separately as on 30th of September, and combine both of them to arrive at the goodwill or capital reserve number. Let us take an example. So let us have two dates, 1st of April and let us say 1st of October. Stake acquired 10% and additional 15%. So 10 plus 15 makes it 25%. Cost, let us say 1 lakh here and 1,50,000 here. Net assets 8,50,000 here, and as on this date the net asset was 10 lakhs. See, why will the net asset increase? During the period the investee or the other entity would be making profits. Because of earning some profits, the net asset would increase, right? Now once 25% stake is acquired, there is a relationship of an associate, and hence we need to calculate goodwill or capital reserve. So what we will do is, first here we will see what is our share in net assets. What is our share in net assets? First case, 8,50,000 multiplied by 10%, our share is 85,000. Here 10 lakhs multiplied by 15%, our share is 1,50,000. Now how much is the goodwill or capital reserve? Now here cost is 1 lakh, net asset is 8,50,000, net asset share is 85,000, means we have paid extra. So when we have paid extra, there is goodwill of how much? 1 lakh minus 85,000, 15,000 is the goodwill. On 1st of October, 1,50,000 is the cost, and 1,50,000 itself is the share in net asset. So there is no goodwill, no capital reserve. So what is the total goodwill? Total goodwill is equal to 15,000. Right. Now if I change this example slightly, and if I say that we didn't pay 1,50,000, but let us say we paid 1,40,000. We paid 1,40,000. What is the net asset? 1,50,000. See, please understand, we are calculating for 10% and 15% separately. On 1st of October for 15%, we paid 1,40,000. We got 1,50,000 of net asset. Means what? We paid less. When we paid less, what comes into picture? Capital reserve. So here you will have capital reserve of 150 minus 40, which is 10,000. Right. Please understand, capital reserve is a credit item, so you can put it in the bracket so that while calculating you don't miss out. So 15,000 of goodwill and 10,000 of capital reserve. What is the net goodwill? The net goodwill will be 5,000 only. Net goodwill will be 15,000 minus 10,000, 5,000 only. Right. So that is how you will calculate goodwill when there are multiple acquisitions. Now if in the second acquisition, if goodwill comes into picture, if let us say we have paid not 1,40,000 but we have paid 1,70,000, then in that case what happens? Again we will have a goodwill of how much? 20,000. So 20 plus 15, 35,000 will be the goodwill. So like this, after every acquisition you need to calculate goodwill. Now sometimes what may also happen is, after an investor has acquired, let us say 20% or 25% stake in another entity, whereby the associate relationship is established, after that also the stake is increased. For example, if you look at this timeline, on 1st of April, let us say we have two entities. A has acquired stake in B. On 1st of April, 25% stake is acquired. Then let us say on 1st of October, another 5% stake is acquired. Now already it is an associate here. Another 5% extra stake is acquired. Now here how do we do the calculation? Same logic. Date by date you will calculate what is the goodwill or what is the capital reserve on every additional stake acquisition. Now say this on 1st of April we have acquired 25% stake. On this date the net assets is, say for example, 5 lakhs. 25% stake will be how much? 5 lakh into 25%, 1,25,000. Let us say cost is 1,50,000. So 25,000 becomes your goodwill, right? So goodwill is 25,000. Why? Because we have paid extra to acquire this. Now say for a moment on 1st of October additional 5% was acquired by paying 20,000. So cost is 20,000. 20,000 is the cost, right? How much is net asset? This is not given. Net asset is not given. What the question has given or what the scenario has given is profit for the year is equal to 90,000 and this profit is earned in the ratio of 2:1, means till 30th of September, from 1st of April till 30th of September, and from 1st of October till 31st of March, the profit split is 2:1. Meaning to say, out of this 90,000, 2 portion has been earned in the first half and balance has been earned in the second half. Now 90,000, if you do it 2:1, that is 90,000 multiplied by 2 by 3. If we do, how much do we get? Here we get 60,000. So 60,000 is between this period and 30,000 is after acquisition, right? Now how do we calculate? What we need to do? We need to calculate net asset on 1st of October. How much is the net asset on 1st of October? See, we have net assets of 5 lakhs on 1st of April. There is no other dividend paid. There is no other transaction which has been given. What has happened is 60,000 of profits have been earned. Always remember, whatever profits are earned, that will increase our net asset. So what is our net asset now? 5,60,000. Our net asset is 5,60,000. Now what is our stake acquired? 5% is acquired. How much is 5%? 5,60,000 into 5%, if we do, we get 28,000. We get 28,000. 28,000 is the share of net asset. 20,000 is the cost. So we have capital reserve of 8,000. We have capital reserve of 8,000. So net amount, if you see, goodwill of 25,000, capital reserve of 8,000. Goodwill of 25,000, capital reserve of 8,000. Net amount, net goodwill is 25 minus 8, 17,000. Right. Now, what is the closing balance of investment? See, first we made an investment of 1,50,000 here. Then we made an investment of 20,000 here. Then there is a profit portion which has been earned. Then there is a subsequent profit which has been earned, right? Now the question is, what is the value or what is the closing balance of investment, right? So for that, what you have to do to calculate closing balance of investment, cost of investment on 1st of April is 1,50,000. This is the breakup is net asset and goodwill. How much is the net asset? 1,25,000. How much is the goodwill? 25,000. This is the first breakup. Then cost of investment on 1st of October. Cost of investment on 1st of October. How much was the net asset? Net asset share was 28,000. Capital reserve is 8,000. The amount that we have invested is 20,000. So total is 1,70,000. Right. Now to this you will add share of profit. Till 30th September we are entitled to 25% share. So 25% of 60,000 is our post acquisition profit, which is 15,000, and we are entitled to 30% of share of balance 30,000, that is 9,000. So why 30% of 30,000? Because from 1st of October our stake is 30% and in the second half we have earned 30,000, that is 9,000. So 1,70,000 plus 15,000 plus 9,000 makes it 1,84,000. This is the closing balance of investment. In this closing balance of investment, we have net goodwill of how much? 25,000 minus 8,000, 17,000, and net assets of the difference 184 minus 17, 1,77,000. So this is how you will have to calculate and show the breakup. Now, one thing that we can understand here, this capital reserve that you have calculated of 8,000, that has two components. One, original net asset was 5 lakhs, that is at the beginning of the year. On this 5 lakhs, if you calculate 5%, you get 25,000. Cost, you get 20,000. So capital reserve is 5,000 for the second purchase. Then there is also a pre-acquisition profit of 60,000. On that our share is 5%. This also is capital reserve portion, which is 3,000. So that makes it together 8,000. So that is another way to look at it, but this is more logical and more intuitive. So you have carrying amount of investment 184, in which goodwill is 17,000 and other net asset is 1,77,000. So students, now we'll understand another aspect where the associate is incurring losses, right? Now, so far what you have understood, you will initially record the investment at cost and you will add profits and you will reduce the losses. Of course, dividends are also adjusted. Now, what if there are losses? To what extent do we recognize the losses? Now, one thing if you remember, for company form of organization, there is a concept of limited liability, right? For example, if we have invested something of, let us say, 1 lakh and acquired some shares of another company, if the company incurs huge losses, are we required to pay anything extra? We are not required to pay anything extra, right? This we have understood as a part of limited liability concept. You have been learning this since the time you were introduced to company form of organization or joint stock company. Now, if I have invested 1 lakh and say for example, my share is 30%. My share is 30%. The company has incurred losses of 5 lakhs. So let us say the associate loss is how much? 5 lakhs. Now, how much is our share? How much is our company's share? 30% of 5 lakhs, that is 1,50,000. Now, if I do this 1 lakh minus 1,50,000, it becomes minus 50,000. Now tell me one thing, can I recognize investment at negative value? I cannot. Second, am I liable to pay this 50,000? I am not liable to pay this 50,000 because my liability is limited. I have made the investment. After that, I don't need to pay anything. So what we need to do is, whenever there are losses, we will restrict the losses to the extent of the value of our investment. So whatever is the carrying amount of our investment, from that we will reduce the losses up to what extent? For example, my investment is 1 lakh. I will reduce only 1 lakh and my amount becomes 0. Now, say for example, in the next year, so what has happened here? I have made investment of 1 lakh, loss share I have taken 1 lakh and now closing balance is 0, right? Now, in the next year, let us say, next year, there is a profit. How much is the profit? Let us say the profit works out to 2 lakhs. Profit works out to 2 lakhs. Now, if you see my opening balance, this is 0 coming from here. I would say add share of profit. 2 lakhs share of profit, 30% if I do, it becomes 60,000 and my closing balance becomes 60,000. Is this the right approach? Think of it. Can I take entire 60,000? I cannot take. Why? Because in the previous period, I have not taken this 50,000 of hit. I said I will take a hit of only 1 lakh. Now, from the point of view of associate, if you see, first year loss is 5 lakhs, second year profit is 2 lakhs. So on a net basis, the net profit if you see or net loss if you see, net loss is 3 lakhs, right. This is a net loss of 3 lakhs. Of this, our share is how much? 30%. So technically, cumulatively, we should take a share of 90,000 in losses. Now, when it comes to second year, because I have not taken this 50,000 of hit in the previous period, what I will do is from my share of profit, I will adjust this 50,000. I will adjust this 50,000. Now, what is my balance? 0, 60,000 minus 50,000 is 10,000. 0 plus 10,000, my balance becomes 10,000, not 60,000. Here also if you see, total loss I should take 90,000. Total investment I have made 1 lakh. So my closing balance should become 10,000. That is what we have derived here. So the way you should work out is, first take the loss, first take the share of loss. Till what extent? To the extent of carrying amount of investment. I will not pay anything extra from my pocket. Subsequently, when the associate starts reporting profit, I will not take all the profits immediately. First I will see how much of loss I did not take earlier. To that extent, I will not take profits also. And only after that, I will start accounting for profits. So what we'll do, we'll look at an illustration from the study material and see how do we handle such scenarios. Let's now have a look at a question where we will see how do we calculate share of losses and how do we restrict and present that in the balance sheet. A Limited acquired 40% of share in B Limited. So B Limited is the associate. A Limited has acquired 40% on April 1 of year 1 for 10 lakhs. So they have paid 10 lakhs. On that date, B had 1 lakh equity shares of rupees 10 each, means total equity share capital 10 lakhs, fully paid, and accumulated profits of 2 lakhs. So 10 lakhs plus 2 lakhs, total net asset becomes 12 lakhs. During the year 1-2, B Limited suffered a loss of 10 lakhs. So first year loss is 10 lakhs, next year 12 lakh 50,000 and then 5 lakhs. So 3 years of losses. Show the extract of consolidated balance sheet of A Limited on all the 4 dates recording the above events, right. So now in this is what we will do, we will see how much is the goodwill on the initial date, that is on 1st of April of year 1, then every year what is the carrying amount of investment and how can we present that in the balance sheet, right. So let's look at the solution. On 1st of April of year 1, cost of investment 10 lakhs because they have paid 10 lakhs. Net assets of B Limited, how much is the net assets of B Limited? 10 lakhs plus 2 lakhs, right. 10 lakhs plus 2 lakhs, how much is that? That is 12 lakhs. Share of A in net asset of B, how much is that? 40% of 12 lakhs. So 12 lakhs multiplied by 40%, we get 4 lakh 80,000. How much is the goodwill? We paid 10 lakhs minus share of net asset 4 lakh 80,000, 5 lakh 20,000 is the goodwill. That is on 1st of April of year 1. Now, in the subsequent period, how do we account for it? To the cost of investment, we will add share of profit or we will reduce share of losses and adjust the dividends. So, calculation of carrying amount of investments on 31st of March of year 2, 31st of March of year 3 and 31st of March of year 4. These 4 calculations we need to do, right. So, now for 31st March of year 2, we have to see what is the cost of investment, 10 lakhs, then less share of losses. Now, how much is the share of our loss? In the first year, you can see the loss is 10 lakhs. What is our share in that? 40%. So, 40% of 10 lakhs, right. 40% of 10 lakhs minus 40% into 10 lakhs, we get 4 lakhs. So, closing balance is 10 lakhs minus 4 lakhs, 6 lakhs. Then next period, we need the opening balance. Opening balance is how much? 6 lakhs. How much is the loss? Loss if you see is 12 lakh 50,000. So, 40% of 12.5 lakhs, right? How much is that? 40% into 12.5 lakhs, 12 lakh 50,000, we get 5 lakhs. What is the closing balance? 1 lakh. In the third year, opening balance is 1 lakh. Share of loss is how much? 40% of 5 lakhs. So you have 40% of 5 lakhs. Now, how much is 40% of 5 lakhs? 40% into 5 lakhs, it is 2 lakhs. Now, do we have 2 lakhs of carrying amount? We don't have. Then what we will do? We will restrict that to carrying amount, which is 1 lakh. So here you can write a note. Here you can write a note. In year ended 31st of March of year 4, the investment, the share of loss is restricted to carrying amount of investment, right? So that is the note you can write, and you can present that in the balance sheet. So 1 lakh minus 1 lakh, it becomes 0. Now here please understand, we got the closing balance of 6 lakhs, 1 lakh and 0. How do we present that in the balance sheet? So let us do that as well. Balance sheet presentation. Now balance sheet presentation on 1st of April of year 1, 31st of March of year 2, 31st of March of year 3 and 31st of March of year 4, right? 4 balance sheets we need to present. Share of net assets. Share of net assets on 1st of April of year 1 is 4,80,000. Goodwill 5,20,000, right? So carrying amount is 480 plus 520, which is 10 lakhs. Please understand, we will not pass a separate entry for goodwill. All that amount will be included in the investment. So what we are bothered is investment of 10 lakhs. On 31st March of year 2, how much is the share of net asset? So to calculate the share of net assets, we will see opening share of net asset 4,80,000 less losses. We don't have profit in this case. How much is the loss? In the first year, we have a loss of 4 lakhs. So you will reduce that. And goodwill continues to remain 480 minus 4 lakhs. So net assets is 480 minus 4 lakhs, which is 80,000. Now this is net assets as on 1st of April of year 1. Okay, that's what we have continuing, right? 80,000. Add goodwill 520. Carrying amount becomes 10 lakh. Carrying amount becomes 80,000 plus 5,20,000, 6 lakhs, right? Now, on 31st March of year 3, if you have to calculate share of net assets 480, then losses. How much of losses we have taken? 4 lakhs here already, and in the second year we have a loss of 5 lakhs. In the second year we have a loss of 5 lakhs. But can we take the entire loss from net assets? We cannot. How much can we take in net assets? 4 lakhs already taken in year 2. We are left with 80,000. So minus 4 lakhs totally minus 80,000. So you get 4,80,000. Or other way what you can do is, you can just take the opening balance of net asset as 80,000 and you can say minus 80,000 of losses. Both the presentations are acceptable, right? So net assets opening balance 480. In year 3 we can take another 80,000. So 480. So share in net asset has now become 0. And what happened to goodwill? Goodwill is 520 less share of losses. How much is the share of losses? See, 80,000 we adjusted here. Totally we need to adjust how much? Totally we need to adjust 5 lakhs. So here we will adjust how much? 4,20,000. So what is the carrying amount now? 520 minus 4,20,000. 1 lakh is the carrying amount. That is entirely your goodwill component, right? In the third year, 480 minus 480, this is 0. Then we have goodwill of 520. Entire goodwill also is exhausted because 420 in the previous year and current year loss of 1 lakh. So 420 minus 1 lakh, 520, and the carrying amount becomes 0. So the closing balance of investment has become 0. Here also if you see it has become 0. So the thing that you have to keep in mind is, first losses you will set it off against net assets. So first year we set off 4 lakhs, second year we had 5 lakhs, but we could set off only additional 80,000. So 4 lakh plus 4 lakh 80,000, this is basically cumulative. Okay, and in the third year also cumulatively net asset has become 0, right? Then coming to goodwill balance, whatever is the balance loss which was not absorbed by net asset will be knocked off against goodwill. So in the third year you have 1 lakh of balance, and in the fourth year you have nil balance. So to summarize whatever we have discussed, under the equity method, when an investor share of losses of an associate equals or exceeds the carrying amount of the investment. So we saw carrying amount of investment initially was 10 lakhs. And once the losses exceeded 10 lakhs, we stopped recognizing any further share of losses, right? The investor ordinarily discontinues recognizing its share of further losses, and the investment is reported at nil value. So once 10 lakhs gets exhausted, you are not showing, or you are not required to show any further losses, unless there is one exception, that is if the investor has guaranteed something, or if the investor has an obligation to pay something to the associate or on behalf of the associate, then in that case you will continue, or you will recognize that part of losses, but otherwise generally you will not recognize share of losses. Now what do I mean by guarantee? Say for example you have A and you have B, okay, and we have invested 1 lakh and we have given a guarantee to a third party saying 20,000 we will pay. B already incurred huge losses, entire 1 lakh got exhausted. This 20,000 of loss should still be recognized, right? Apart from that, no further losses will be recognized. Now moving on to the next part, that is about date of the financial statements. Now generally financial statements are prepared as on 31st of March of a particular year. There is no problem. We will take the same date financial statements and we will carry out the consolidation process. But if the year end dates are different, sir, how can it be different? Maybe the associate is a US based company. In that case, you have 31st of December of a year for the associate and 31st of March for the investor. In that case, what should we do? We should take the closest balance sheet available, but in no case it should exceed 6 months. So the date of financial statements that you are taking, it should not exceed 6 months. The gap between both the financial statements, that is investor and the associate, that financial statement gap should not exceed 6 months. Most ideal scenario is take the same date financial statements and prepare the consolidated financial statement as on the same date. But if there is a difference, take the latest, but it should not exceed 6 months. If the reporting date is different for the financial statements and the investor, so if there is a difference, for example 31st of December and 31st of March, then you should make adjustment for the effects of significant transaction that occur between those dates. Meaning to say, whatever significant transactions have occurred, take 31st December, but don't consolidate using 31st December balance sheet. Take 31st December balance sheet, make adjustments for significant transactions, not small transactions, material and significant transactions, and as on 31st of March, take the information and consolidate the balance sheets. Then, when it comes to accounting policies, it should be uniform for like transaction and other events in similar circumstances. Same thing what you learn in consolidation also. The accounting policies followed for similar transactions should be same. If accounting policies are not uniform, then adjustments are made in the individual financial statements to bring in line with the consolidated statement. May be possible, one entity is following accounting standard, another entity is following US GAAP. Okay, let us say this entity is consolidating. This US GAAP financial statements, you will translate that or you will restate that to comply with accounting standards, and then you will consolidate, which means the associate will prepare two different set of financial statements, right? So accounting policies has to be consistent. If it is not consistent, you have to make adjustments. Then if there is a decline in the value of investment other than temporary, that should also be recognized. You should reduce the carrying amount of the investment. This is similar to what we learn in AS 13 as well. Now coming to the next part, that is contingencies. If the investor is also contingently liable for contingencies and capital commitments of an associate, then that should be disclosed. And contingencies that arise because the investor is severally liable for the liabilities of the associate. So if, say for example, associate has given a guarantee to whom? To a third party. This investor also over smart, He said, I will also give guarantee together, means I am severally liable, means I am independently liable also for this guarantee, that also should be disclosed. So, if at all there are contingent liabilities for which the investor is also contingently liable, that has to be disclosed. Then there are certain disclosures that are required as per AS 23 when there is consolidated financial statements including an associate. What are the disclosures? Listing and description of associates including the proportion of ownership interest and voting power should be disclosed. Meaning to say, list down all the companies where you have investments and what is the extent of ownership and voting power, that has to be disclosed. Then investment in associates using the equity method should be classified as long-term investments and disclosed separately in the consolidated balance sheet. So, it will always be a long-term investment. Then the investor's share of the profits or losses of such investment should be disclosed separately in the consolidated statement of P&L, and any extraordinary or prior period item should also be disclosed separately. So, you have to disclose the share of profit separately in the consolidated P&L. Please remember, in the standalone P&L of the investor, all of these will not come. This will come only in the consolidated financial statements. Then, the name of the associate of which reporting date is different from that of the financial statements of an investor, and the differences in reporting dates should be disclosed in the consolidated financial statement. So, if at all reporting dates are different, disclose that. Then, if the associate uses accounting policies other than those adopted for the consolidated financial statement, and if it is not practicable to make appropriate adjustment, then the fact should be disclosed along with brief description. So, what did we learn? We said, if the accounting policies are different, make adjustments. If the accounting policies are different, make adjustment. Sir, it is not possible to make adjustment. Why? So many transactions, so many complexities, and impact is not much material. Then you may still say, okay, we will not make those adjustments, or we are not able to derive the values and hence we are not making those adjustments. In that case, you will disclose that fact and make a description or give a description as to what are the accounting policies and why did you not make adjustments and related aspects. Then, if an associate is not accounted for using the equity method, then the reason for not doing the same. So, we will subsequently understand there are some cases where equity method is not followed. In that case, you have to disclose that. And then, goodwill capital reserve arising on the acquisition of an associate by an investor should be disclosed separately, though it is included in the carrying amount of investment. That is what. So, whenever you disclose investment, you will have the investment at total, let us say 1 lakh, and goodwill has to be disclosed separately. It is not that in the balance sheet you will say 60,000 is investment, 40,000 is goodwill, not that way. Goodwill has to be only disclosed separately, right? Now, that is as far as disclosures are concerned. Then, if there is a proposed dividend, we know proposed dividend are not recognized. So, accordingly, you will not make adjustments for proposed dividend. And one more aspect, if there are potential equity shares, then that should not be considered in determining whether the other party is an associate or not. Sir, what are these potential equity shares? Remember, when you learned earnings per share, there you understood about potential equity shares. For example, share options or convertible instruments. Those things should not be considered in determining whether the investee is an associate or not. Let's now understand cases where we do not follow the equity method of accounting as per accounting standard 23. So, there are two situations where we do not apply equity method of accounting even though the investee is an associate. What are those two cases? First, when the control is intended to be temporary because the investment is acquired and held exclusively with a view to its subsequent disposal in the near future. Meaning to say, we acquired the investment. The other party, we can exercise significant influence, but we are exercising or we will exercise that influence only temporarily. The control is intended to be temporarily. We will sell it off maybe in the next 3 months or next 6 months. In the near future, we will sell it off. So, in such case, we will not apply equity method. So, then how will we include that investment in consolidated balance sheet? You will apply the principle of AS 13 as if it is any standalone investment. Then, it operates under severe long-term restrictions which significantly impair its ability to transfer funds to the investor. Now, if you see, how did we account for these associates? We took the cost, we added our share of profit. We added the full share of profit and recognized the share of profit in P&L. Whereas, in case of other investment, what do? We only recognize the share of dividend that we get. But here we are recognizing full share of profit. Now, if there are restrictions there are severe long-term restrictions. If there are severe long-term restrictions, means the investor may not be able to get the dividend amount, investor may not be able to realize the share of profit, which significantly impair the ability to transfer funds. The associate will not be able to transfer funds back to me. That is, in that case, I will not apply the equity method. The reason being very simple. If I cannot get my share of profits, if I cannot get funds from my investor, from my investee, then how will I recognize that as my profit? In that case, we do not recognize. Now, sir, what could be the example of this? Say, for example, you have acquired 30% in a Chinese company. Okay, you have acquired 30% stake in a Chinese company. Now, as per Chinese government regulations, whatever profits are earned by that company, that is the Chinese company, that cannot be sent outside China. It has to be invested there only. Sir, then why did we buy? Maybe we wanted some influence, we wanted some raw material, we wanted some technology. That is why we bought it. Now, in that case, will we get our share of profit? We will not get our share of profit. So, that we should not recognize, right? So, that is where we should not recognize. Accounting should happen as per accounting standard 13. Now, the question comes, what is this near future? This is generally a term not exceeding 12 months, less than 12 months period, right? So, that is one thing. Then, now what we have seen in the previous part is when we do not apply the equity method of accounting. Now, we will understand when should we discontinue the use of equity method of accounting. An investor should discontinue the use of equity method from the date that it ceases to have significant influence in an associate but retains a part of its investment. The use of and retains a whole or part of its investment, or the use of equity method is no longer appropriate because the associate operates under severe long-term restrictions that significantly impair its ability to transfer the funds to the investor. So, first scenario is the investee is no longer my associate. Either I have sold off some stake, for example, I had 30% stake, I sold off 15%. If I sell off 15% with the balance 15%, I am not able to exercise influence, right? That is one case. Or even without selling, I don't have the ability to maybe nominate the board of directors, appoint someone on the board of directors. I am not able to exercise significant influence. From that date, you will stop applying equity method and you will continue to apply or continue to recognize the investment using accounting standard 13. One thing, whatever was the carrying amount as per equity method, that will continue to be the cost of investment for the purpose of consolidated financial statements. That is the first thing. Second, it is no longer appropriate because the associate now operates under severe long-term restrictions. Earlier, the Chinese government did not have any restrictions. Suddenly, India banned so many apps of China. Chinese also said, all your investment, you cannot take the money back. So, once the restrictions comes into picture, then you will no longer use the equity method. After that, you will account for it as per AS 13, and the carrying amount of the investment on that date should be regarded as the cost for the same purpose, right? So, these are the two things that we need to keep in mind when we do not apply equity method and when we discontinue applying equity method. Let's now have a look at the next question. Here there is a mid-year acquisition and there is also a part of pre-acquisition dividend. How do we account for all of that? Let us have a look. Bright Limited acquired 30% of East India Limited for 2 lakhs on 1st of June of year 1. So, mid-year acquisition. So, whenever there is a mid-year acquisition, you have to be careful about net asset on the date of acquisition and also whether there is any pre-acquisition dividend or not. Please remember, pre-acquisition dividend as per AS 13, what do? We reduce from the cost of investment. If you have forgotten, go back and revise AS 13. By such an acquisition, Bright can exercise significant influence over East India Limited. During the financial year ending on 31st March of year 1, East India earned profits of 80,000. This is what? This 31st March of year 1. We acquired after that. Please be careful of the timeline. So, this is 31st of March of year 1. We acquired on 1st of June of year 1. So, profit, this 80,000 is earned before this period. Okay. Then from 31st March of year 1 till 31st of March of year 2, how much is the profit? They say they have declared a dividend of 50,000 on 12th of August of year 1. So, here on 12th of August of year 1, there is a dividend. They reported earnings of 3 lakhs for the financial year ending 31st March of year 2. So, here there is a profit figure. How much? 3 lakhs. So, from 31st March of year 1 till 31st March of year 2 profit is given, and declared a dividend of 60,000 on 12th of June. Subsequently they have declared dividend. Assume profits are accrued evenly. Calculate the carrying amount of investment in separate financial statement of Bright Limited as on 31st March of year 2, consolidated financial statement as on 31st March of year 2 and 30th June of year 2. So, these three things we need to do. So, let us do one by one. Again, to avoid any confusion, let us properly prepare the timeline. This is 31st of March of year 1. So, before that they have made a profit of 80,000. When did we acquire? 1st of June of year 1. When was the dividend declared? Somewhere in August of year 1. Right. This dividend is declared out of this 80,000 profit which is earned. Then 31st of March of year 2. For this entire period we have some profit. It is 3 lakhs and earned evenly throughout the period. So, this period and this period we have to split the profit now. So, please do not consider June and say 3 months. It is only April and May because it is on 1st of June. So, here it is 2 months and this part it is 10 months. So, 3 lakhs divided by 12 multiplied by 2, if I do 2 6 are 12 to 50,000. So, 50,000 is earned here and in this 10 months we have earned 2,50,000, right. So, that is one more aspect we have to say. Then on 12th of August they have declared a dividend. How much is the dividend? On 12th of August dividend is 50,000. Please remember, we have not received full 50,000. We will receive only our share. How much is our share? 30%. So, we will receive only 30%, right. That is the information. Then somewhere here in June of year 2 they have declared a dividend and the dividend is 60,000. This 60,000 is from the previous period investment. Now, what they have asked us is to calculate the value of investment in standalone and consolidated financial statement as on 31st of March of year 2 and as on 30th of June of year 2. Of course, we do not have profit figures for the next period, so we will ignore that. One more thing, this 60,000 of dividend which is paid out of the profit of the previous period, there is also a pre-acquisition component and post-acquisition component that will have an impact in the standalone financial statement, but in the consolidated financial statement that will not have any impact. Okay, I will show you how will it not have an impact, and because we are asked to prepare only consolidated financial statement, we can directly prepare that, right. Now, coming back to the question, out of this 80,000 profit that has been earned, there is a dividend which is declared on 12th of August. How much is the dividend? 50,000. Of that our share is 30%. So, 50,000 into 30%, 15,000 is our pre-acquisition dividend, right. So, cost of investment is equal to, how much did we pay? 2 lakhs less pre-acquisition dividend 15,000. So, 1,85,000. This is the cost of investment, right. First thing that they have asked, cost of investment in separate financial statement. Then, so carrying amount is 1,85,000. Second, carrying amount in consolidated financial statement as on 31st of March of year 2. How will we do that? First, cost of investment as per 1,85,000, add share of profits. Now, how much is the share of profit? See, the profit after our acquisition, only post acquisition, is 2,50,000. Our share is 30%. So, 2,50,000 into 30%, that is 75,000. So, 185 plus 75,000, 2,60,000, right. Did we get any dividend in the first year? Yes, we got. But do we need to deduct it? We should not, because we have already deducted the dividend here. Here, this number 1,85,000 is already after deduction of dividend. So, no need to deduct again. Now, the thing that I was telling you is, in case we consider, this is just for your understanding, if you do not deduct pre-acquisition dividend and just take cost of investment, that is 2 lakhs, add profit How much? 75,000. Then here you can do less dividend 15,000. So 2 lakhs minus plus 75 minus 15, you get again 2,60,000. So that is what I was saying, it will not have an impact, right? So what is this 2,60,000? Carrying amount in consolidated financial statements. Then we also need to calculate carrying amount, the third part of the question, carrying amount as on 30th of June of year 2. So for this we need carrying amount as on 31st March of year 2, 2,60,000. Add share of profit for 3 months. Do we have? We don't have. So we will not consider that. Less dividend received. How much dividend did we receive? 30% of 60,000. So we have received a dividend of 18,000. So 260 minus 18,000, 2,42,000. This is the carrying amount of investment. Very, very simple chapter, very, very simple concept, and if you practice enough, you can score very good marks in this particular chapter. So let's have a look at the next question. A Limited acquired 25% of shares in B Limited as on 31st of March of year 1 for 3 lakhs. So how much is acquired? 25%, means it becomes an associate. Who becomes an associate? B Limited becomes an associate. The balance sheet of B Limited as on 31st March is given below. Now on the date of acquisition, the balance sheet is share capital, reserves and surplus. Now what are these? These are your net assets, right? How much did this company acquire? 25%. So if you calculate 25% of this, you have a share of 2,50,000. How much did they pay? They paid 3 lakhs, right? So we have a goodwill of 50,000, right? Then they have given fixed assets, investment, current assets. So that is nothing but the breakup of net assets. During the year ended 31st March of year 2, the following are additional information available. A Limited received dividend from B Limited for the year ended 31st March of year 1 at 40% from the reserves. Now, whatever is the reserves and surplus available here as on 31st March of year 1, from this 40% dividend is paid. Now, how do we calculate this 40%? Don't do 40% into 5 lakhs. Of course, share capital and reserves are same, but this 40% when we say, it is 40% of face value, that is share capital, which means 2 lakhs. Now, will A Limited get entire 2 lakhs? It will not get. How much will it get? It will get 25%. So 25% if you do, you get 50,000. 50,000 is the dividend received by A Limited from B Limited. Now tell me one thing, is this pre-acquisition or post-acquisition dividend? It is pre-acquisition dividend. Now pre-acquisition dividend, as per accounting standard 13, what will you do? You will reduce this from investment. So in the standalone financial statements, you will reduce this amount from investment. Sir, if we remove this amount from investment, will my calculation of goodwill change? In the consolidated financial statement, the calculation will not change. Goodwill will remain 50,000. In the current study material, and I hope they will correct this error in the study material, what they have done is, they have reduced this 50,000 from investment, and accordingly they have calculated goodwill as 0. Okay, that is the current status. I hope they will correct it subsequently. Now, please understand, even if pre-acquisition dividends are received, goodwill calculation will not change. I will show you how does that work, right? Then, B Limited made a profit after tax of 7 lakhs for the year ended 31st March of year 2. So, profit after tax of how much? 7 lakhs for 31st March of year 2. So, subsequently they have made this profit. How much share will we get? We will get 25% share. Then, B Limited declared a dividend of 50% for the year ended 31st March of year 2 on 30th of April of year 2. Now, this impact we will give in the subsequent period. A Limited is preparing consolidated financial statement in accordance with AS 21. You are required to calculate goodwill on acquisition, how A Limited will reflect the value of investment in B Limited in the consolidated financial statements, and how the dividend received from B Limited will be shown in the consolidated financial statement. So, these are the things we need to calculate. So, let us do one by one. Now, first, calculation of goodwill. Share in net assets 2,50,000. Cost of investment 3 lakhs. So, goodwill is 50,000, right. Dividend received will be credited to investment account because it is a pre-acquisition dividend, right. Because it is a pre-acquisition dividend, it will be reduced from the investment. So, revised cost of investment is equal to 3 lakhs minus dividend what they have received 50,000. We have already calculated above. You can put that as a working note, right. That is equal to 2,50,000. Dividend received is equal to 40% of 5 lakhs into 25%, that works out to 50,000, right. Now, here when we calculated, we said 3 lakhs. Now, our cost of investment is 2,50,000. Will the goodwill calculation change? Please understand, goodwill calculation will not change because of pre-acquisition dividend. Sir, why? Just look at this. Net assets on 31st of March of year 1 is equal to 10 lakhs less dividends paid. See, they are paying dividend out of reserves on 31st March of year 1. So, net assets which is pre-acquisition will also reduce accordingly. How much is dividend paid? 2 lakhs, right, 40% of 5 lakhs. So, balance is 8 lakhs. A's share is 8 lakhs into 25%, that is 2 lakhs. So, 2 lakhs, if you compare with 2,50,000, there also you will get goodwill of 50,000. That is how it is calculated, right. That is the first part of the question which says calculate the amount of goodwill. Now, second part, how A Limited will reflect the value of investment in B Limited in the consolidated financial statement. How will you do it? You will take the investments made, you will reduce any dividend received, you will add share of profit, right. So, value of investment, how much did we make? How much investment did we make? We made an investment of 3 lakhs. 3 lakhs plus share of profit. How much is the profit? 7 lakhs. 25% of that minus dividend received. So, value of investment, cost of investment 3 lakhs, add share of profit 25% of 7 lakhs, that is 1,75,000, 4,75,000 minus dividend 50,000, that is 4,25,000. So, this is the value of investment in the consolidated financial statements. This includes goodwill of 50,000, right. How the dividend received from B Limited will be shown in the consolidated financial statement? Dividend received from B Limited will be reduced from the investment in the consolidated financial statement, and the dividend received on 30th of April, this one, the third one, the dividend received on 30th of April, that will not be reflected in the 31st March balance sheet. It will be accounted in the subsequent period as a reduction from the investment. Right, this is how you will approach this question.